But let me talk through, so hopefully I've given you an overview of the mortgage market chain and the fact that demand pull created a lot of the issues here, that the bankers and brokers, which honestly are getting, in my mind, a little bit unduly criticized, were really just providing what the market demanded. So my point is that if the bankers, and first of all, if the bankers and brokers didn't provide these, somebody else would have, because there's so much demand for it from the GSEs and the investment houses. And of course, if the GSEs and investment houses couldn't package these into bonds and resell them, the demand pull would have stopped. So there was also demand pull from the investors, because they saw, hey, these assets are very safe, supposedly, and producing good cash flows, supposedly. So this is kind of the demand pull, and understanding this is very important before you start going and throwing money at it to try and fix it. And also it's important to understand because the whole issue of price discovery comes into play, and that's where these blue stars come in. It's a very important piece, and it's the main piece that I'm going to finish up on here in this first lesson about price discovery, because this is a crisis of price discovery. This entire thing from start to finish. How much are these mortgages worth to these investors? Why were they pulled through at such incredible volume? Why would an investor buy a subprime bond that was a bomb? Right? Why would that happen? Unless there's a fault in price discovery along the way. And this is one of the biggest issues that we're running into, and really needs to be adjusted and fixed, I believe, for this mortgage chain to work properly. Now we have other issues because of this now that have spread to the greater economy. People's housing prices to come down and things. Not very difficult to explain though, because if there's so much demand and we're opening the door in the subprime area especially for a whole bunch of people that we in essence mortgage their future by allowing them to be qualified when they shouldn't have quite yet. We've really ruined someone's future down the road by allowing them to get into a financial obligation that they weren't quite ready for, which is very sad. And what it did was it qualified a whole group of people, a whole bunch of people that shouldn't have yet been qualified. Not that they should have never been qualified, but weren't quite ready to be qualified for mortgages. Those people bought houses, and we increased the number of people who owned houses up considerably, and that drove the price of houses up for everyone else. So it raised the level of water in the bathtub, if you will, for everybody. And of course what happens is when it's found that those people can't really pay back, then those houses have to get sold, and then the bathtub water goes lower for everyone, in fact lower than when it started. And that's kind of the overarching understanding of some of the financial area. You take liquidity out of the housing market, and the average person now's house is worth less than it was before, and the person who had nothing to do with this is getting burned. But the last point I want to make in this lesson is the whole idea of the price discovery mechanism, and that's these blue stars. Between both of these transactions, from mortgage-backed securities that the bank packages and resells, to the more complex, what we'll call financial derivatives and mortgage-backed bonds that get packaged and resold by the investment houses and GSEs to the investors, there's a price discovery mechanism. Now let's go back and think about our Kelley Blue Book again for a second. At each one of these points, these people, this group, these entities are the buyers. These entities are the buyers of these mortgages, mortgage-backed securities. These entities are the buyers of these assets. So it's inherent that these buyers beware, that they understand fully what these mortgages packaged are worth. Likewise, these investors, mutual funds, pretty complex people here. People understand this stuff. Pensions, mutual funds, foreign funds, and banks. It's implicit on them that they understand what they're buying, the cash flows that they're buying. So it's very important that the buyer beware. So what happened? Why and let's from a demand pull perspective walk backward. Why did these investors overpay for these assets? Because that's what they did. They overpaid for these financial assets, and then found out only later. And the thing about loans, they found out later because, remember, loan losses come in after the fact, and you really don't know it at the start. what the loan loss rate's going to be until many months and sometimes 18 to 24 months later. So why did they make such a mistake in overpaying? And then why did the GSE's investment house make such a mistake in overpaying? And we're going to look at that a little bit more in lesson 2.